This is how I'm making money on every single trade, even when I'm completely wrong. No matter what the market throws at me, I found a strategy that consistently delivers reliable profits with minimal risks. And you know what? It's easier than you think. Stick around because by the end of this video, you'll see exactly how I do it, and you can use the same process to start generating consistent income from your trades. Plus, I'll share a bonus tip with you later in the video that shows how I make even more money from this strategy, not just from the trades, but from additional income that I get on the cash I set aside for these trades. You won't want to miss it. I've been trading options for over 13 years, and believe me, I've seen it all. The ups, the downs, the times when I thought maybe this is it. But through all that, I discovered one thing that has kept me consistently profitable: selling cash secured puts. Now, before you go, wait, I've heard that before and it's not that special. Stick with me because I'm going to show you how to simplify the entire process. In fact, this is the exact strategy that's helped hundreds of traders in my community turn inconsistent gains into steady monthly income. Now, here's the part that makes the strategy so effective. It's simple, predictable, and low risk, and it gives you a steady paycheck regardless of whether their stock goes up, down, or sideways. In just a minute, I'm going to show you exactly how I set up my trade so you can see the entire process step by step. But first, let me break it down for you. So what is a cash secured put? Simply put, it's when you sell the right for someone to sell you stock at a certain price. In exchange for that, you get paid up front. The beauty here is that even if the stock doesn't move in your favor, you still keep that premium, meaning you're getting paid whether the trade goes perfectly or not. That's how I profit from every trade. It's almost like getting paid to wait for the right price. I'll show you what you need to look at when you sell a put to get consistent results. But while we're at it, let me show you a quick example of a trade I'm in right now that I was completely wrong about, but I'm still currently up 32% on this trade. As you can see here, I sold a cash secured put for Costco stock at the $800 strike price for the December 20th expiration date. When I did this on September 26th, Costco was trading at around $908 per share. I'd love to own Costco stock at $800, so I sold the 800 strike put and collected $1,074 in premium. So as long as by the December 20th expiration date, Costco stock can go up, down, sideways, as long as it's above $800, I get to keep that $1,074 I got paid up front. As of today, Costco is trading at around $888. It's gone down $20 since I sold the put, so I was kind of wrong. But because of time decay, I'm already up 32% on the premium that I collected so far. So I collected $1,074 in premium, and I can close this trade right now for $725 and pocket the difference as profit, even though the direction I was expecting, it didn't go that way. Pretty great, right? Now, to make the strategy as effective as possible, there are two important factors you need to pay attention to: delta and the expiration dates. These two elements can make a big difference in your profitability. I like to sell puts with a delta between 0.2 and 0.3. This means that the options that I'm selling have a 20 to 30% chance of being assigned, meaning I might end up buying that stock. But that also means there's a 70 to 80% chance it's going to expire worthless and I get to keep all my premium. So why this range? It strikes a balance between collecting a decent premium and minimizing the chances of being assigned stock that you don't want to hold immediately. At a delta of 0.20, you're less likely to get assigned, but you'll still collect a solid premium. For expiration dates, I typically sell cash secured puts that are 45 days out or more. And why that far out? Well, there are a few reasons for that. First, the premium you collect is much higher the further out you go, which gives you more income up front. Second, when you sell options further out, the price decay, also known as theta, starts off slow and then speeds up as you get closer to expiration. By selling 45 days out, I can take advantage of the slower decay period, which means I can close the trade earlier and lock in profits before too much risk builds up. Plus, having more time on the trade gives the stock more room to move in your favor, reducing the likelihood of assignment. Now, here's the key to locking in your profits. You don't always have to wait until expiration to close the trade. I typically look to close my cash secured put positions when I've captured about 50 to 75% of the total premium. Why, you ask? Because after you've made most of that money, the remaining premium isn't worth the risk of holding this trade until expiration. For example, if you sold a put for $100 in premium and you can buy it back for $25, it's usually a good idea to lock in your $75 profit and reduce your risk exposure. This way, you free up your cash to sell another put and keep the income machine rolling. You're maximizing your returns without taking on unnecessary risk. But here's where most people go wrong. They overcomplicate things. They try to sell puts on every stock that pops up on their watch list, or they go too aggressive on risky stocks. And that's how they end up in trouble. You've got to keep it simple. Focus on quality stocks, don't go chasing the high premium on questionable names, and stick to what you're comfortable with. I've helped hundreds of traders cut through all that noise and simplify their approach, focusing on stocks they're confident in, and it's completely transformed the way that they trade. In fact, many of them now generate reliable monthly income using this exact method, and they spend way less time worrying about the market. If you want to join my trading community and get real-time alerts on the trades that I'm actually making, check out the link in the description below. Now, here's a bonus tip that can really take your monthly income to the next level. I park the cash I set aside for my cash secured puts in a money fund that earns around 4.7% annual interest, while I'm using that same cash to collect premium from selling the puts. This means I'm earning money from two sources, not just one: the interest from the money fund and the premium from the options I sell. It's a simple but powerful way to boost your overall returns, and it helps make the strategy even more effective for generating steady monthly income. So yeah, check with your broker if you can do that as well. There are many reputable brokers. I use Schwab for that, and they're great at this, okay? Now, let me show you exactly how I set up my cash secured puts trades step by step. You'll see the whole process from selecting the stock to executing the trade, so you can follow along and apply it to your own trading. Trust me. Once you see how easy this is, you'll wonder why you haven't been doing it all along. So let's dive into my screen back there, and I'll show you exactly how it's done. And the first thing you need to do is select the right stock. Now, I always choose stocks that I wouldn't mind owning in the long term. This is critical because if the trade doesn't go the way I expect, I want to feel comfortable owning those shares. I look for high quality, strong stocks that I'm confident will grow or at least hold their value over time. And this is just an example, so do not copy this trade, okay? I'm going to execute the trade so I can show you guys how it's done, but do not copy this trade because I don't know when you guys are going to be watching this. So let's say I'm looking at a stock like Tesla, okay? I check its performance, review its fundamentals and technicals, and make sure it aligns with my investment goals. One of my indicators that I use is showing me right here that it is oversold, right? Because it is the oscillator is showing it under the 20. So that means it's oversold. Last time it was oversold right here. It made a nice run up. And then even the time before that when it was oversold, it made a nice run up. So while Tesla is oversold, I like it. So I'm going to go for this one for this example. Okay. Next thing that I do is I want to check out the fundamentals. I want to look at what the implied value is compared to what the market value is right now. So for stuff like that, I use Market Chameleon, okay? So the tools that I use like Market Chameleon and also my indicators, I've got a link to them in the description below, so check them out if you like. So I'm going to click right here. I'm going to go into Tesla. And then when it pulls up all of this data, I'm going to go into fundamentals. I go into fair value. And it's showing right now that the implied value based on, the PE ratio, price sales, all of that other stuff, the implied value is $342 a share, but it's currently trading at a 36% discount. So I'm like, great. If I can pick up shares of this even lower than that, that'd be amazing. So why not sell some cash secure puts and collect some premium, right? So even if I'm wrong, boom, get some premium out of it. So when this looks good and the technicals are looking good, so I'm expecting Tesla to go up, but even if it goes down, I don't mind owning it. That's where this strategy comes in, where you can make money even if you're like completely wrong on a stock. So once I'm satisfied with the stock, I move on to the next step, which is selecting which option to sell. Okay. So here, when I'm looking at the 218 mark right here, where it's trading at right now, I'm comfortable owning the stock right around the 190 to 185 because that's where the next bullish order block is, and that's where the next support is. So I'd be happy owning it right around there. So I'm going to go into Schwab. This is where I trade my cash secured puts because I can park money into one of their market, money funds, which gets me about 4.7% annually while I'm using that cash to sell cash secured puts. So I'm going to type in Tesla, go into options right here, and then this is expiring 4 days from now, so I'm going to close all of these out. And for expiration date, I like to go at least 45 days out or more. And the reason for that is simple. So 45 days, there's no 45 days, there's 60 days. So let's look at the 60 days. All right. And the reason for this is simple. The further out you go, the higher the premium you collect. Plus, selling options further out gives you more time for the stock to move in your favor while still benefiting from time decay. So I'll select an expiration date that's 60 days from now. Okay. And for the strike price, I like to usually go with a delta between 20 and 30. I just want to look at puts. So I'm going to move that to puts, strikes 24s. I'm at 60 days out. Here's my delta. So right here. So this is a 0.21 delta right now, which is a $190 call. Right? So for a $190, I'm not $190 call, $190 put. Okay? So that's what I'm comfortable with because it's showing me a delta of 0.21, which tells me that there's a 79% chance that this will expire worthless. I'll get to keep my premium, and there's only a 21% chance that it's going to get assigned. Great odds for me. I'm super happy about that. And the volume and the open interest looks good on that as well. So the way I'm going to do this trade is I'm going to click on the bid because we're going to be selling the put option. And for each contract, it's $6.05 per share. So because each contract controls 100 shares, I'll collect $605 per contract. So for this, I'm going to go ahead and I'm going to do 3 contracts. I'm going to go ahead and sell 3 contracts because I like that price. Okay. And this is my income from the trade, regardless of whether the stock hits the strike price or not. So let me go ahead and execute this because now this is showing me for 3 contracts, I'm going to collect roughly around $1,800, right? So what I usually do is I try to execute it on the midpoint first. So let's go ahead and review. And check this out. So this is where it's cool because you see how available cash it says it's only $576, but I'm using the money I've put aside in the money fund to be able to do this. So this way, my cash balance shows not much, but this is going to tie up $19,000 per contract. So I'm doing 3 contracts, right? And I'll take you guys into the math of this because this is where it gets very interesting. So I'm going to collect $1,827 in premium. Let's go ahead and get this executed. All right, let's look at the order status to see if it executed. Bam, filled. Okay, so now if I go into my account, go into history, right? So guess what? I sold this. I collected immediately. They deposit $1,827 into my account. Now, this is where it gets interesting. You can be like, okay, so I got $610 per contract, but it's tying up $19,000. You know, it doesn't seem like a lot of money tying up that much capital, right? But think about it this way. Let me pull up the calculator. All right. Now look at this. $610 divided by 19,000. That is a 3%, 3.21% return on the money, and that's in just 60 days. Okay? So let's take this math a little bit further, right? Let's annualize this. So if that's in 60 days, which is 2 months, right? So let's multiply this by 6, so that would be 12 months. That's an annual return of 19.26%, right? So you take 19.26%, and then on top of that, I'm going to add 4.7% that my money's already earning in interest sitting there. So for this super low risk trade, If I can get almost 24% return on that, not owning anything, that is amazing, right? And that's how stuff like this can create consistent income, right? So I executed that trade. Now let's see how it plays out. And if you guys found this helpful, make sure you stick around and watch the next video where I'm going to break down how small traders are making big money with options trades, okay? You won't want to miss it.